Welcome back to the Trade Auto Masterclass. Today, we are looking at the exact mechanics that separate profitable traders from the rest. In Part 1, we established your baseline tools, market orders, limit orders, and stop-loss parameters. But knowing what a stop-loss is will not save your capital if your execution timing is structurally flawed. The actual battleground is right here, your broker's order screen. Look closely at these toggles: GTT, IOC, MIS, and CNC. Today, we are decoding exactly what these buttons do. We will break down GTT orders, execution validity types, and the critical mechanical difference between MIS and CNC. Untrained beginners often treat this interface like a casino slot machine. They click buttons based on gut feeling and adrenaline, hoping for a rapid payout. Professionals treat the terminal entirely differently. To them, it is a precise logic engine designed to execute a predefined strategy. Mastering the mechanics of order flow is the only way to mathematically decouple your trading decisions from your human emotions. Let's start with the mechanical problem. What exactly happens to your pending orders when the market closes? The answer lies in validity types, the programmed rule dictating how long your broker remembers an instruction. This diagram tracks order lifespans. The top row is your standard day order. The day order lives and dies within a single session. Unexecuted orders are wiped at 3:30 p.m. On the opposite extreme is IOC, or immediate or cancel. Notice there's no timeline here, just a single decision point. It is a zero-patience method. But long-term strategies require GTT, good till triggered. Watch the bottom timeline. It bypasses the daily close, remaining active for 6 to 12 months. The core logic of GTT is patience. It instructs the broker to wait until your exact price is met, regardless of the day or month. Consider a stock trading at 1,033 rupees. Your technical analysis identifies a strong support level at 980 rupees, but you have no idea if it will take 3 days or 3 months for the price to drop. By setting a GTT order, the instruction rests dormant, checking the price automatically every morning. However, this automation has a mechanical cost. To guarantee execution, the broker locks the required capital inside a digital vault for the order's duration. Those funds cannot be deployed elsewhere. If you place too many GTT orders simultaneously, you will completely paralyze your portfolio's liquidity. Used correctly and with proper allocation, GTT is the ultimate tool for technical traders. It neutralizes the emotional friction of daily monitoring, ensuring you buy exactly where your logic dictated. This brings us to the most dangerous toggle on your entire terminal: MIS versus CNC. This visual compares the two environments. On the left is MIS, which stands for Margin Intraday Square-Off. This is strictly for intraday trading. MIS imposes an absolute mechanical deadline. Every position you open must be closed by 3:20 p.m. that exact same afternoon. If you fail to close manually, the broker's algorithm forcefully sells your position before the bell, regardless of profit or loss. Now, look at the right side. This is CNC, cash and carry or delivery trading. CNC grants you actual ownership of the underlying shares. They sit securely in your DMAT account, completely insulated from intraday time pressure or forced liquidations. Looking at these two structures, which environment do you think is mathematically safer for a beginner to operate in? The answer is CNC, always. Artificial time pressure unnaturally accelerates your decision-making, and that forced speed inevitably generates catastrophic emotional panic. The data proves this structural flaw. This chart visualizes the official data published by SEBI. It shows that an overwhelming 90% of intraday traders lose their capital. That 90% failure rate is no coincidence. Intraday trading is a highly specialized skill, demanding strict discipline, never a starting point for a novice. The MIS structure catalyzes emotional errors, while CNC protects your agency, giving your technical thesis the actual time it needs to play out. To see the severe cost of confusing these mechanics, consider the case of our student, Vikram. Vikram spotted a volatile stock reacting to news and attempted a quick intraday trade. But in his rush, he clicked CNC instead of MIS. Immediately after his order executed, unpredicted bad news hit the market. This chart models what happened next. The price plunged until it hit a hard horizontal floor and flatlined entirely. That flat line is a lower circuit, a daily price floor programmed by the exchange to halt panic selling. Look under the hood at the order book. Notice the imbalance: 50,000 pending sell orders and exactly 0 buy orders. At the lower circuit, liquidity completely vanishes. Because there is not a single willing buyer, executing a sell order is impossible. If Vikram had used LIS, the broker's algorithm would have attempted a square-off, or he would have taken a sharp single-day loss. By accidentally selecting CNC, he was trapped holding a depreciating asset for days, watching it hit circuit after circuit without any auto square-off protection. Knowing these mechanical realities, why do beginners continue to chase highly volatile intraday setups despite the massive risks? The answer is entirely psychological. Humans crave the adrenaline rush of rapid price ticks. They mistake the trading terminal for a source of entertainment. But the stock market is the most expensive place on earth to seek entertainment. Confusing these order types bypasses all technical analysis. It transforms systematic execution into pure gambling, which practically guarantees capital destruction. To survive this environment, you must adopt strict structural safeguards. Here are the 6 golden rules of execution every professional uses. Rule 1. Start out small. Treat your first trades purely as tuition fees paid to the market. The execution mechanics you learn trading with 5,000 rupees are identical to the mechanics of trading 1 lakh. The only difference is the scale of the damage when you inevitably make an error. Rule 2. Trade only highly liquid assets. Sticking to large-cap stocks guarantees there is always a dense population of active buyers and sellers. This directly prevents the scenario Vikram faced, ensuring you do not get trapped in an illiquid lower circuit. Rule 3. Use limit orders. Placing market orders surrenders your pricing power to the exchange. Limit orders are the only way to maintain absolute control over your entry price. Rule 4. Make the stop loss mandatory. A stop loss is not a polite suggestion. It is your ultimate mechanical defense against financial ruin on a single bad setup. Rule 5. Practice infrequent monitoring. Do not fall into the toxic habit of checking your portfolio every single hour of the day. Constant observation forces you to react to market noise. It directly triggers the exact emotional decisions that derail well-planned technical setups. Finally, Rule 6. Execute algorithmically. You must follow your strategy, not your gut feeling. When the technical setup hits your target, you execute the trade. Numbers do not lie, but human emotions always do. Profitable trading is a mechanical process of discipline. These rules force you to prioritize mathematics over adrenaline. Your immediate next step is practical. Open your broker interface today. Practice configuring limit, stop loss, and GTT orders. Do not hit execute. Just navigate the UI to build the physical muscle memory required for actual trading. In our next module, we will move past the terminal and map out the core mathematics of the stock market, exploring the exact mechanics of compound interest. I am Shubham with TradeAuto. Stay disciplined and keep learning.